In critical situations, police use multiple tools to avoid mistakes and make the right call. Trading is no different. Relying only on RSI can lead to false signals. That's why we add ADX to confirm trend strength and avoid bad trades. In this video, we'll show you how to combine RSI and ADX so you don't miss opportunities and, at the same time, avoid heavy losses. Let's dive in. Understanding RSI and overbought and oversold levels. RSI, or the Relative Strength Index, is a momentum oscillator that ranges between 0 and 100. Traditionally, an RSI above 70 is considered overbought, while an RSI below 30 is seen as oversold. Many traders assume that an RSI above 70 signals a selling opportunity, and an RSI below 30 indicates a buying opportunity. However, this approach is not always true. Why? Because RSI doesn't measure trend strength, it only shows how fast price has moved relative to past performance. In a strong uptrend, RSI can remain above 70 for an extended period without a significant price drop. In other words, while RSI is in the overbought zone, the price can continue rising. Selling as soon as RSI crosses above 70 may cause you to miss further upside opportunities. Similarly, in a strong downtrend, RSI can stay below 30 for a prolonged period without an upward reversal. In other words, while RSI is in the oversold zone, the price can keep declining. Buying as soon as RSI drops below 30 might result in catching a falling knife and suffering further losses. So, how do we avoid these false signals? That's where ADX comes in. What is ADX? ADX, or the Average Directional Index, is an indicator that measures the strength of a trend on a scale from 0 to 100. It doesn't indicate whether the trend is up or down. It only shows how strong the trend is. ADX Levels. ADX tells us whether the market is trending or ranging, and if it's trending, it shows us the strength of the trend. ADX ranges from 0 to 100. If it's between 0 and 25, it means the market is ranging. If it's between 25 and 40, it means the market is trending, but the trend is not very strong. If it's above 40, it indicates a very strong trend. Combining ADX with RSI. ADX below 25. When ADX is below 25, the market is ranging, not trending. In this case, RSI entry signals into the overbought or oversold zones can be relied upon for potential reversals, as price is more likely to move within a range. ADX between 25 and 40. When ADX is between 25 and 40, the market is trending, but not extremely strong. RSI entry signals into the overbought or oversold zones can still be useful, but should be used with caution. It's important to consider other factors such as price behavior, support and resistance levels, candlestick patterns, and volume. These elements provide a clearer view, and relying on RSI alone may not be sufficient, so a broader analysis is necessary. ADX above 40. When ADX is above 40, the trend is very strong, and relying on RSI entry signals into overbought or oversold zones is not recommended. In this case, following the trend is the best strategy, as the trend is likely to continue for a longer period. Practical market example. This is the Euro to US dollar chart on the 1-hour time frame. As we mentioned before, many traders use the RSI entering the overbought zone as a sell signal. However, to complete this strategy, confirmation from the ADX indicator is needed. In this case, after the price moved up, the RSI entered the overbought zone. At the same time, the ADX is showing a value of 15, which is below 25, indicating a ranging market. This means that the RSI crossing above the 70 level is a valid sell signal. We can see that if a sell trade was executed based on this strategy, it would have been well-timed, as the price remained in a ranging phase after the signal. Thanks for watching. If you found this helpful, make sure to like, share, and subscribe for more updates and insights. Stay tuned for the next video.